I'm Adrian Helfert, the CIO of Multi-Asset at Westwood. Thank you for your time. On every investor's mind today, of course, is what's happening internationally. The fact that Russia has invaded Ukraine. What does this mean for overall asset allocation, for US markets, for equities, for valuations? We're already in a dynamic that has seen a dropping US equity market from, in part, expectations that this might happen, and in part because the US Federal Reserve is pulling the punch bowl. They're going to be hiking rates. We have looked significantly at what some of the scenarios are in the situation. Of course, it's very hard to predict geopolitical dynamics, what's happening in the backroom discussions, where this might go. We're already getting feedback on the fact that we're going to be putting stops on various pieces of activity, like the Russian banks, and what that's going to mean for the markets. Broadly, some of the outcomes are, yes, there is a concern that this is a protracted activity over in the Ukraine. Yes, there's a concern that this could drag in some more of the European nations. There's a likelihood, I would say, that this moves faster, that either this leads to a cessation of activities, whether that means Russian occupation or otherwise. Broadly, for the US market and for us as investors, we are looking at what this means for uncertainty in the environment. Uncertainty in the environment at a top level means that the US Federal Reserve is going to be a little bit more cautious, likely, on how fast they hike interest rates in the United States. By hiking interest rates in the United States, they have said that they're concerned about inflation. They're concerned about the demand impact of inflation, especially. Well, if we have a reduction in demand from maybe a consumer that's a little bit more cautious, a little bit less sentiment that is positive for the forward activity, then we could see a lower consumption dynamic, but that will be offset by the possibility that the Fed will remain observant of the uncertainty that's in the environment from this. So we're watchful of that. We'll see what the US Federal Reserve does. The supply chain impacts could increase. We've already had negative supply chain impacts from things that are, of course, COVID driven, that are demand for labor driven. Those supply chain impacts have been part of the issue with our inflation rising significantly. We could see more of this now. We could see more elongated supply chain impacts. We could see impacts on the expected inflation to the economy. As supply chain impacts, that's less concerning to me than demand impacts of inflation. I think the central bank could look through that a little further and expect those to be resolved as we see either cessation of activity, increased labor supply coming back to the market as COVID concern lessens. Though there's some both sides of the coin there, but we will see some supply chain impacts. Energy prices are at the forefront. Energy prices are rising, of course, because Russia is one of the world's largest producers of crude and natural gas and distributing that. What that does mean is that means that gas prices have gone up significantly since 2020 already. For many, that increases the impact on their bottom line for those that are traveling to their job significantly. So as we go through this, as we see inflation and gas prices rising, something we're watchful for is the consumption impact of gas prices rising. All of these things have opportunities, but that, by and large, could impact negatively some of the U.S. population. So we'll see how that manifests itself through. Will we see more supply given from U.S. suppliers, from shale, from the Middle Easterns? We think that is likely, but that we will see elevated energy prices for some time, and therein lies opportunity. Energy companies are able to be cash flow positive at this point, and we see positivity there. We see good investment prospects there for those that are those companies that are giving back more cash to their investors, and they are doing capital allocation in a better way than they are in the past. The US dollar is likely to remain elevated in valuation. That's something we're looking at as well. It's opportunities and it's areas to avoid as well. The US dollar would remain elevated because it's a safe haven. It's a place that many companies and many investors go when they're concerned about rising uncertainty in the environment. We see that today with the US dollar up significantly, especially relative to the euro. So that's something we're mindful of. Now, by and large, there are both opportunities and there are concerns. The concerns are this devolves into a longer conflict that could potentially drag in others. This leads to elevated uncertainty for consumers. This leads to elevated energy prices that erodes purchasing power for US consumers. These things we're mindful of. The opportunities are to look through that some to find areas of your portfolio that are less assuaged by higher interest rates, that maybe have some protective features like good cash flow production, the energy companies, those that actually could be positively benefiting from some of the transition that we'll see in consumption patterns or corporate purchasing patterns. Say cybersecurity is one of those areas that we've talked about, that we could find possibility, we could find increasing spending for, just as we might see increased defense spending as well. Defense companies can benefit from this. So as investors, we're always looking for opportunities. We're recognizing changing landscapes in the economic environment that we're in. We remain reasonably positive and can see a way through this, but certainly we'll be mindful and look forward to communicating to you more. Thank you for your time today.